Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Tuesday, the 9th of May. I'm Daniel Lam, your host for the podcast. In preparation for the Asian Games in September, I've been looking for warm-up tournaments to join in Europe. Naturally, I've been looking at the euro-dollar exchange rate, which has been recovering strongly over the last 9 months. In a nutshell, we're expecting the euro-US dollar to rise towards 1.12 to 1.15 over the next 3 months. The still elevated inflation, resilience in business sentiment, and reduced growth downside risk means that the ECB is likely to maintain its tightening bias. Last week, the ECB raised the deposit rate by 1/4 of a point to 3.25%. We see likelihood of another 25 bips rate hike, with risk skewed to the upside due to the still elevated core inflation, and then hold for the rest of the year. This means further divergence in policies between the Fed and the ECB, as we're expecting the Fed to cut rates in the second half of the year. Further decline in US versus German bond yield differentials is likely to push euro-US dollar higher. Thus, while there appears to be good resistance in the currency pair around 1.12 to 1.15, technically the pair may eventually retest 1.20 over a longer period. Now, the other key question from clients regarding Europe is what should they be doing with equities there? Well, the 12-month forward price earnings ratio for European equities is around 12 times. On a relative basis, the Euro-area PE is at a 20% discount to global equities, which is at the bottom of a historical range. This fairly balances the risk to growth in the region. Technically, the Euro Stoxx 50 index has been making high highs and high lows, which is bullish, but at the same time, it is at a triple top. It is back at the levels before the Russian-Ukraine war started. The equity index appears to have completely digested the issues surrounding a disruption in energy supplies, but it does make sense to gradually trim into strength and rotate into assets such as Chinese equities, which has been lagging in prices and showing more positive economic surprises compared to Europe. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.